I now hand the conference over to Mr. Jinesh Gandhi from Motilal Oswal Financial Services. Thank you, and over to you, sir.
Thank you, Stephen. Good morning, everyone. On behalf of Motilal Oswal Financial Services, I would like to welcome you all to Q2FY21 post-results conference call of Ashok Leyland. Ashok Leyland is represented by Mr. Vipin Sondhi, MD and CEO, Mr. Gopal Mahadevan, Whole-time Director and Chief Financial Officer, Mr. K.M. Balaji, Vice President Corporate Finance. I would like to thank the management for taking time out for the call. I would now hand over the call to Mr. Sondhi for his opening remarks. Over to you, sir.
Thank you, Jinesh. Namaskar, ladies and gentlemen, on behalf of Ashok Leyland and my two colleagues and myself. This is Diwali week, so wish you and your families a very happy Diwali. I'll start from where we left off the last time, that it gives me immense pleasure to meet you all once again for this post-result conference call of Ashok Leyland. We had interacted during mid-September for the launch of our next-gen LCV platform, the Bada Dost. And before that, at the launch of our Avatar range of medium and heavy trucks powered by the innovative iGen 6 mid-NOx engines. That was sometime in June. We've also launched the Boss LE-LX versions, as you might have gathered, to address the needs of the growing ICV market segment. And all these products are doing very well in the market, receiving positive feedback from the customers, and we are very happy and proud of them. Let me take you through the highlights of Q2 performance. One is, we all know that the first quarter volume was a virtual washout due to the lockdowns, the pandemic. The MHCV industry recorded a very low, abysmal actually, volume of 4403 vehicles in Q1, which was 94% lower than the corresponding quarter of last year. The second quarter has been much better, and the MHCV TIV has jumped 4.5 times to 24,552 vehicles sequentially. This is about 50%. Even now, it's about 50% of last year's volumes in the same quarter. That's Q2FY20. Hello, can you hear me?
Oh, yes,
hello?
You may go on.
Oh, sorry. So I'll just repeat the sentence. This is about 50% of last year volumes in the same quarter, Q2FY20, 48,018 vehicles. Now, it's nice to see and heartening to see a gradual but steady recovery in demand towards pre-COVID levels. During Q2, ALMHCV volumes have jumped 8.5 times to 6,994 vehicles sequentially. Our market share has improved from 16.5% in Q1 to 28.5% in Q2. The volumes at 6,994 numbers are about 50% lower than last year Q2 numbers, which is 14,637 numbers. We're also seeing recovery in the export markets. You're aware that many of the markets were closed. Now these markets are gradually coming out of their own lockdowns. And our MHCV exports in Q2 are at 935 vehicles, as against 298 vehicles in Q1. Last year, Q2 export volumes were at 2117 numbers. LCV volumes have touched near pre-COVID levels, are at 11,508, 11,508 vehicles, which is about 95% of last year's volumes of 12,123 vehicles. Q1 LCV volumes were at 2793 numbers. The revenue for the second quarter has jumped 3.5 times sequentially to rupees 2,837 crores. Q1 revenue was at rupees 651 crores. EBITDA has also improved to a positive 80 crores, 2.8% in Q2, from a negative 333 crores, which was minus 51% in Q1. Ashok Leyland has reported a PAT loss of rupees 147 crores for Q2 against a PAT loss of rupees 389 in Q1. During Q2 last year, AL had reported a revenue of 3,939 crores, EBITDA of 229 crores, which is about 5.8%, and a PAT of 39 crores. We, Ashok Leyland, where we've manufactured 8,431 MHCVs during Q2, which is 1133 vehicles in Q1, and have ended the quarter with an MHCV inventory of 1853 numbers. Production numbers for the corresponding quarter last year was 14,238 numbers and 10,103 vehicles in inventory. The June 20 MHCV inventory was 1,354 vehicles. Our Q2 closing operating working capital was negative at approximately 500 crores vis-a-vis rupees 860 crores positive in Q1. Last year Q1 working capital was at 1,200 crores positive. The Capex till September 20 was at rupees 290 crores versus 532 crores in the same period last year. Capex has been incurred mainly towards the modular business program, the Bada Dost program, and EVs, electric vehicles. Investments were at rupees 108 crores, rupees 90 crores in HLFL in April 20, as against rupees 58 crores during the same period last year. During the quarter, rupees 1,200 crores cash has been generated from operations, predominantly through the reduction in working capital, and this has been used to repay debt. Our debt as on 30th September 20 stood at 3076 crores. That is a gearing of 0.45 times versus rupees 4284 crores, which is a gearing of 0.62 times in June 20. The debt as on 30th September 19, that was last year, was rupees 2,736 crores with a gearing of 0.37 times. We see every quarter getting better than the previous quarter. We've launched new products and we're looking forward to the future. And with this brief introduction on quarterly performance, may I hand over to Gopal to add and then move it forward. Thank you.
Yes. Thank you, Vipin. I think you have encapsulated the performance well. The idea was to look at the comparison of Q1 versus Q2 because this is an exceptional year where everything had shut down in the first quarter. So what is important to see is how is the industry ramping up and how is the company doing, in terms of the industry performance. And as MD had rightly said, we continued with our plans unabated in terms of launching the new products, both Avatar range of products as well as Bada Dost, which have been received very well in the market, very encouraging responses. The second part of it is that we continued our journey of operational cost and efficiency driving from last year itself. We had K54.2 last year. This year we have the Project Reset, which is driven all across the company with on a pan-company initiative of not just cost reduction but profit improvement plans, bottom line improvement plans, which includes revenue enhancement, volume enhancement, VAVE, manufacturing cost reduction, looking at how to tackle material cost reduction, and all overheads. So that's one of the reasons why we have possibly been better than street estimates in terms of EBITDA margins, and we will continue on that journey as Q3 and Q4 roll on. And more importantly, I think what I would also want to share with all of you is that if the street estimates for industries and the overall estimate that we read through various reports, we could be wrong. It all depends on the report, but it's around 25 to 30% degrowth for the full year. If that estimate is right, then at the current level of degrowth, which is significantly higher, which is at about 70% or so, 70 or 75%, Balaji can give that number, it means logically that Q3 and Q4 should be good growth quarters. And that's exactly what the company is also readying itself for. We would need to ensure that, we keep our production facilities intact to meet the demand as it rises. And we believe that once COVID situation goes away, and I think all of this is going to depend on when the vaccine is invented, we would actually see a robust demand coming in. That is what logic tells us. I think MD has already said that this quarter, the cash management has resulted in the debt reduction of nearly 1,200 crores, so which has brought our debt back into a comfortable position. And I would also want to add here, I'm sure that this will be one of the questions, is that our ICDs have come down further as I speak to you, because very recently we had another 100 crore repayment, which is very much in track of what we had shared with you at the beginning of the year. So the total ICDs as we speak to you today is only 300 crores. With that comments, I would now hand it over to Jinesh so that you, all of you, can have the opportunity to ask questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ronak Sarda from Systematics. Please go ahead.
Hi, good morning. Thanks for the opportunity. So first question is, on the demand and inquiry trend, are we seeing inquiries coming back from, let's say, large fleet operators now? And because we have almost seen, more than 12 months that the replacement cycle has been, being lacking there. And are we seeing any different trends now, given the post-COVID experience? And also how much demand is dependent on financing availability? That was the first question.
Yeah, I'll just briefly answer it, and I would request our MD to answer this. We're certainly seeing the demand coming back. I think what's happening is as the finance companies are also gaining confidence in the sector, because the entire sector, both the MHCV and the finance NBFC sector, have gone through quite challenging times over at least especially in Q1 and then Q2 with the moratorium. I think we're seeing the lending coming back to people who are paying back after moratorium or who have not availed moratorium. And the sector is also opening up, because you can see that slowly the sectors, various sectors are also opening up. So I think we would see the demand coming back in Q3 and Q4, but now I'll hand it to MD to expand on that.
Thank you, Gopal, and I think you've given it all. But, every part of the CV space will have a different trajectory, and that will happen at all points in time. So we definitely see infrastructure moving, so tippers are moving. We see LCVs, as I had mentioned earlier. So segment by segment are coming. Your question on large fleet operators, it's only a matter of time before they come in. We have inquiries started. The answer is yes. Have some of them started buying? The answer is yes. And as economic activity picks up, we feel that they will come back as well. But the trajectories are different for different subsegments.
Sure. And the second question is for Gopal. Assuming, production volumes ramp up like you highlighted, second half should see a growth. Can you help us understand how the costs move up? So especially raw materials, commodities are inching up, and also on the other expenses. So how would be the operating leverage play out? Which costs are we able to control much better? Some guidance on that, please.
Yeah, you see, and I'll also request MD to add in case I miss something, because basically, we are going by what is prediction. So the predictions are that the industry is going to be low for the full year by about 25 to 30%, which looks like a bad headline. But then the silver lining of the cloud is that means Q3 and Q4 have to be growth quarters. And going by the trend, we believe that it should be because at least here in India, the impact of COVID is slowly waning down. While the number of cases are going up, the number of cures are also going up significantly, and it looks like the virulency of that virus is also abating a bit. And let's hope that we are different as far as the second wave of COVID is concerned. If this happens, we're going to see a lot of sectors opening up. We're even seeing some parts of the entertainment sector getting opened up, which means it's a good sign. The second thing is, yes, we will see operating leverage kicking in, because we are managing costs. The whole team is managing costs very, very efficiently, astutely. And material prices, yes, there is a pressure, you're right, on steel prices are going up. So we have actually taken price increases even in October across MHCV as well as in LCV. And we have been able to fetch better realizations than expected, even in Q2. because BS6 had actually had a transition cost from BS4 to BS6, obviously, because of the better technologies and the requirements of having additional exhaust system had added cost to the vehicle. But we have been able to see one of the most important things that we're doing in Leyland is we are selling the vehicle on the basis of fluid efficiency and total cost of ownership. So what happens is ultimately when the fleet operators see that the Avatar range of products or even the LCV or the Badados are actually more efficient vehicles, then what happens is there is a tendency to look at the vehicle as a whole in terms of a life cycle. And that's actually, we're finding that that's selling very, very well. Having said that, I would also like to specifically clarify that we are extremely competitive on pricing. And more than pricing, I would say on cost. We believe that as we move forward into Q3 and Q4, we should do much better in terms of margins, provided the volume growth happens, which we are reasonably confident of. So both cash management, cost management, productivity, I would say improved penetration, seeing that dealers are, more liquid than they were in the past, and there's a huge amount of effort that's being taken to ensure the liquidity of dealers and ensuring that our vendors' payments are also on time and they're also liquid. I think there's a confluence of efforts that's actually born into this performance in Q2, which will get better and better with the coming quarters. MD, would you want to add it?
The only thing I'll add is all of what Gopal has said is encapsulated, as he mentioned, under reset. So it's not about cost, it's about profitability, cash and Capex management, and it's led by Gopal himself. So you can see that he's very eloquent about it, and we are highly focused and review this on a continual basis so that we ensure that operating leverage kick in due course.
Sure, sir. Thank you and all the best.
Thank you. Thank you, Ronak.
Thank you. The next question is from the line of Gunjan Prithyani from JP Morgan. Please go ahead.
Yeah, thanks for taking my questions. I had two questions. Firstly, if you can share a bit about Leyland Finance in terms of, what are the collection efficiencies you're seeing in that business, and also if there is any thought process around the kind of capital requirement that can come from the subsidiary. Just general asset quality, and also what you're reading from the customers at Leyland Finance, which can give us some sense on the market conditions.
Yeah, thanks, Gunjan. Actually, Leyland Finance is performing very well under the circumstances. Just to give a very broad headline number, both in H1 and Q2, their revenues as well as their has been better than last year. Now, H1 revenues were at 1,469 crore, and their PAT was 145, and last year was at 1,466, I think, and about 141 crore. Similarly, Q2 performance was also much better, and this is after taking into account, COVID provisions that has been taken. So there has been quite a bit of, I would say, conservatism in that. So as on date, this is all after factoring in additional provisioning of nearly, in March, we had taken, if you remember, I had shared that we had taken a provision of 70 crores. For the first half, additional 55 crores has been taken, which makes it nearly about 125 crores of provision being taken, after which you have the performance coming in. So asset quality has been good. I would say that the borrowing cost has also been ratably better. The liquidity position in all buckets, be it 7 days, 15 days, 1 month, 3 months, or 5 years, the liquidity position is extremely safe, and they have adequate lines of credit with banks. And I would say that as a percentage of AUM, the NPA stands at about at around 2.3%. So the collections have been getting better and better, and we're actually seeing that the strategy of HLFL to be diversified is also helping. So they are not only MHCV lender. Their book of MHCV should be around 40-45%, but then you have two-wheelers, three-wheelers, off-road vehicles, loan against property, and special purpose papers which are brought in, all of which actually add to two things. One, a very efficient liquidity management so that there is no single sector exposure that will take a huge hit. And the second one is that the returns are also well done. Because obviously, the net interest margins on sectors like two-wheelers and three-wheelers is significantly better, even after factoring in the NPS. So this has kind of helped the company in current times.
Anything you can share on collection efficiencies, where we are versus pre-COVID levels?
Well, I think I think the morat is, that it's at about 30-35%. I'll have to share that number somehow. I'm not able to trace that paper. But otherwise, the collection efficiencies are improving much, and I don't see any major reasons, major concerns on the collection efficiency.
Okay, the second question is, you kind of touched upon certain segments where you're already seeing inquiries inching up, tippers and ICVs. If you can give us a broad sense of, how much of these categories account for in the overall pie where you're, decisively seeing improvement in demand. I mean, specifically tipper, trailers, ICVs, proportion of the overall industry.
See, I'll just quickly give a headline, and then I'll hand it over to our MD also. But for us, tipper, tractor, trailer, and multi-axle vehicles form a very significant portion of the demand. You see, I also wanted to share one thing with you in perspective. We are India's largest, bus manufacturer, and in 2019 we were top three within the top three global bus manufacturer. One of the reasons you will actually see the market share getting a little skewed are two reasons. One is the south, non-south. We expect the south demand to pick up as we move forward. So there's a lot of numerator denominator effect as well on this. The second one is buses have yet to pick up because of social distancing. So some of the largest consumers of buses are for the state transport undertaking. Only now transportation is getting back. Public transportation is not fully fledged running, but they have started to push, and the buses have started to ply, and it's a great effort done by all governments. The second one is schools are yet to reopen, right? So then that is another sector where we've seen that the demand is virtually zero. The third sector is, of course, corporate transportation. Again, so we have seen that since a lot of people, including the ones on the call, are all working from home, you don't see corporate transportation taking off. So the bus segment, which is actually a very important segment for us, and which I'm very hopeful will start increasing as we move forward, that also kind of skews the percentage. As far as your specific point is concerned, all I can tell you at this moment is that multi-axle vehicles, tippers, tractor trailers form a very significant portion of the demand. And so are ICVs. We have become our market shares in ICVs as about 5 years ago was hardly about 10-12%. And today we are, supra 20%. We are at about 22-23%, if my memory serves me right. And for us, ICV is becoming an important segment, and you will hear a little bit about the ICV products in the future. But I'm going to hand it over to him.
Just to add to what Gopal has said very well, it's really that the Boss LE LX is something we launched. So you will see that our market shares have grown significantly in ICVs. So we will be playing there. The Avtar, to take it back, the Avtar is really giving us fluid efficiency. And we're saying fluid efficiency because it's both diesel as well as the AdBlue, which is required for BS6, is giving us significantly better results and therefore greater savings for our customer. We will be value selling our products to ensure that the total cost of ownership, as Gopal had mentioned earlier, will be the prime driving point from a point of view of our consumer over the life cycle of our product. Specifically, how much is each segment going, it's difficult to say simply because the market is volatile, and over a period of time is when we will see stability in the market. We will play to our strengths while ensuring more and more products are coming across all segments.
Got it. Gopal sir, did you share anything on the capital commitment? Sorry for the Leyland Finance if I missed it. I mean, any assessment that's been done?
Well, we'll look at what is the capital commitment required for Leyland Finance. Maybe about another 100-120 crores may be required. We don't know at the moment. We are not putting any capital. We don't plan any capital infusion in Q3. But having said that, I'm not so concerned about it because this is actually growth capital. Very clearly, the company is doing very well. And if the company requires capital, it is not for any net worth reduction. It's required for the growth of the company, to grow the book. And that's exactly so. If you ask me, I'm not too concerned about the capital that is to be infused into HLFL, because HLFL has always been, even through tough times such as this, it's been a very big positive accretor to the Ashok Leyland balance sheet. And the number is not very significant, by the way. So, and we are not really in we are in a very comfortable debt equity position, and we wouldn't want to also not invest in initiatives which are growing well. This is one part. The second part is just to kind of add to your, to kind of give a number to this, ICV versus the rest. ICV today really accounts for approximately about 27%, and the rest of the trucks will account for the balance. So, and last quarter, like our MD said, the ICV segment was at about 38%. So we've seen some wild swings that happen quarter on quarter. But all I can tell you is that this segment of haulage, tipper, tractor, and multi-axle vehicle is very, very significant, as I mentioned earlier.
Sure. Thank you. I'll join back with you.
Thank you. The next question is from the line of Binay Singh from Morgan Stanley. Please go ahead.
Hi team, thanks for the opportunity. My first question is on the discounting environment. Doing some channel checks in October, we note that the discounts have risen quite sharply, mainly by your peers, as inventory levels have normalized. Do you see that as a sort of a trend pan India, that the discount levels are high? And secondly, could you also comment a little bit about your inventory and where you see industry inventory levels?
Well, very quickly, we have been mentioning this for the past so many years. Frankly, that what matters is the net realization more than the discounting.
Hello?
Because what matters is the net realization more than the discounting. So what we are trying to do is to improve our net realization across each of the categories. And we have been able to do that. At the beginning of the year, we had prepared kind of a business plan factoring in COVID and downsides. But we've been fortunately been able to, improve our realizations against those plans. I would request MD to add on the discounting and the pricing. But on the inventory levels, all I can tell you, the number is very insignificant because, as Vipin had mentioned, our operating working capital is negative, which means that our receivables plus inventory is lower than our payables. Now, we would certainly want it to improve we don't want to have too much of negative working capital as well. But all we can tell you is that we're not pushing inventory into the system. That never happened. That's why when we had BS3 to BS4 transition, there was no significant hit to the company. Similarly, when we went from BS4 to BS6 transition in March, if you notice, there was not any significant impact. Simply reason because we produce only what we plan to sell and not what we want to push. I would now request MD to add, please.
Thank you, Gopal. So on inventory, just to carry it, we focus a lot on what is being retailed so that we ensure that what is required is what is available at the dealerships and not what is, just kind of pushed. It's extremely significant. It's a significant management policy that we have. On discounting, it is at best on a tactical basis. As I mentioned, we are working to value sell the products. And Avatar is a first of its kind as a modular business platform. It gives the benefit to the customer right through then back into the value chain to our supplier base. It's something that is catching on, with fluid efficiency being the main reason. What a customer sees straight away in the first month, 3 months of operation. As the vehicles fly more and more on the road, this will become extremely apparent. So we will value sell. Will we have to take some tactical calls? Perhaps. But the focus is on deriving value.
Thanks. That's very helpful. Could you just give us numbers on engine, spares, and defense for the quarter?
Balaji, can you just give a rough percentage of these businesses? One thing that I would add, these businesses have played out very, very well. So, for example, even in Q1, while the revenues were very small, almost all of these revenues came from LCV, defense, engine power solutions and aftermarket. And similarly, in the second quarter as well, I think aftermarket revenues are at pre-COVID levels. So is power solutions business. LCV, as MD had mentioned, are almost at pre-COVID levels again. And the introduction of Bada Dost, we believe that that is adding fillip to us, and that is helping us getting where we are. And As far as the international market is concerned, we are waiting for things to open up when we actually would see, a volume increase when the relevant markets open up. But having said that, Balaji, you can just share the thought percentage.
Yeah, for spares it is roughly 14% delay, and for engines it is 5%.
So Vinay, if I might add to what Gopal, Balaji, I'll just come in and then you can come back again. I just want to add to what Gopal and Balaji is saying is that very early in late April, actually, we started ensuring that was for the reasons that we wanted truck supply to ensure that that public goods at that time, which were food and medical supplies. So we were opening up very quickly as far as our service points were concerned to be able to supply spares. Now that has stood us in good stead as we've gone into May, June, July, etc. And therefore you see very heartening performance on spare parts. Defense, of course, the order book is good. And engines, as much as we can supply the power solutions business, they're all doing well. But back to you, Balaji.
Yeah, for LCV it is 20%.
Thank you. The next question is from the line of Jay Kale from Elara Capital. Please go ahead.
Yeah, thanks for taking my question. So my first question is regarding the kind of vehicles sold. I mean, last 2 years we've seen that the tonnage growth has been lower than the volume growth. We've seen post the axle load norms increase, some bit of downtrading happening. Going forward, you mentioned that ICVs are outperforming, so are tippers. How do you see the mix going forward in the next 1 or 2 years? Are we to assume that the downtrading to a certain extent has been done with, or you still believe that because ICVs will outperform the other segments, you could still see overall tonnage growth being lower than volume growth for the industry?
Well, I would say that this is it's like really peering into the future and taking a guess. But I would see that the tonnage growth would be better than the volume growth is what I see. The mix in the past has been different, but we must also remember one thing. This is not just about the axle load norms. It's all about the trifurcation of the overall transportation industry because of the GST. So you're seeing, for the first time, you're also seeing that industry has not degrown as it has in the MHCV segment. We are all waiting for when the MHCV kind of came off quite sharply. Over the last 2 years, all of us were expecting that LCV would also come off, but it has not happened despite the COVID. That's because, the intra-city transportation continues to be pretty robust and the requirement for that has changed. Similarly, ICV is a different segment, completely different from the MHCV segment. And that's why you're seeing that the whole transportation requirement is becoming very specific, and I think that's good for the industry. What's happening is the fleet operators are also doing a lot of sharp shooting. So they're going to invest in vehicles which are tailored for their requirements. And I know this may sound a little very pro Ashok Leyland, but that's exactly what modularity is all about. We are actually ensuring that Ashok Leyland brings in that capability which the fleet operator requires. His requirement is that I would want to buy vehicles which are tailored for my requirement, and modularity is going to give the fleet operators exactly that. So from a company perspective, we are pretty confident that we have kind of readied ourselves for any kind of change that the industry may want. But I think better heard from within.
So Gopal, you've explained it all and well at that. The important thing is, of course, that some amount of what happened in the axle load norms has been absorbed by the industry. There's no doubt, and fleet buying will come. But I think we want to change fleet buying to what Gopal said is based on application should be the purchase, and we're the only ones who can do that with modularity. So why have a large fuel tank and carry a lot of fuel when it's going to be short city runs or short intra-city runs, and have a large fuel tank when you have a larger cross-country run, etc. That will save a lot on the efficiency of the trucking system and the service as well. And as we mentioned, tippers were very strong, great results on total cost of ownership. ICV more products, market share gains, and LCV again with the Barados. We have a portfolio to ensure that we play with the vagaries of the market.
Yeah, and just to add to what our MD said, one of the things that we possibly are missing is the kind of elaborate systems we're building to ensure that truckers are able to look at their efficiency. So there's a lot of telematics today in the vehicles. We have got a huge uptime research center, uptime solution center, which has now got the capability of monitoring how the vehicles are performing. We are able to interact with the fleet operators more efficiently now, giving them tips on what's happening with their vehicles. There's a lot of data that's coming in which we're sharing with fleet operators. They're essentially appreciating this. So similarly, the entire warranty management system has changed. Our quality processes have changed. So when we look at it both from within the company and outside the company, we are actually trying to drive efficiencies within the company and also ensure that these initiatives, especially on digital side, is reaching the fleet operators. So over the next few quarters, you will actually see the differentiation that these kind of initiatives can make. Because we're trying to see, kind of looking at this whole thing in a more wholesome manner than just selling trucks and, trucks or buses and then just walking away. I think that is where the differentiation comes in, aside of, what Vipin had touched upon about the modularity itself.
So if there is a question on digital, I'll wait because it's a great initiative of our company. So we can take it up if somebody has a question. It's a very positive initiative that we are undertaking.
Sure, so that would be great if you can just highlight a little bit of the digital initiatives as well. And also, just to add to that, you mentioned that, there have been increased inquiries in the month of October as well. If you could just give some flavor of what are these kind of inquiries in terms of first-time buyers versus, the large fleet operators coming back for replacement. How has that changed versus pre-COVID levels, and how do you see it going forward?
Okay. Gopal, should I go first?
Please go ahead. In fact, my mic was on mute. Please go ahead.
So let's come to digital, and it's really picking up from where Gopal left. The whole focus is how do we drive digital as with the customer at the heart of the decision-making process for digital. So we actually start with what the customer may need. Maybe the customer has not asked for it. The customer, especially the fleet customer, and increasingly the individual will want to know what is the health, productivity, and if it's a fleet operator, at what stage of operating efficiency, preventive maintenance, etc., downtime, all of that information should be available. We have the Uptime Center, as Gopal said, centrally. But we also have quick response teams in the field, which are cross-functional teams that are fed this information almost proactively so that they can attend to customer requirements almost before the event happens, from a pre-service or if there's a breakdown, which there will be, to attend to it, because data is all available and then fed back to the fleet. Now, this is going to be a continuous process, and you know that. I mean, if digital was enhancing at 3x pre-COVID, it's just gone up to 7x, 8x, and we've reinforced the digital team. But at the end of the day, the customer is the heart of the decision-making process, and then we work back with all the apps. For example, we have an app called Laycart, and you would know that. And during COVID, Laycart actually, it's a platform on which spares can be bought. Laycart actually showed a massive enhancement in the way spares were being purchased. Now that's kicked off and is going to keep going forward. There are many, many such examples that the digital team has undertaken. So you'll hear a lot from us on the digital initiatives. On the other question of whether fleet operators, individual buyers, a lot is related to the smaller trucks, which is the light commercial vehicles, some to ICVs, and more would be fleet operators as the truck ticket size keeps going up. Now, we took a massive opportunity, all of us, to interact with our customers virtually during this entire period of lockdown through to this day. So we're talking to them, interacting with them, explaining our products, and this starts from the managing director, including Gopal, and of course the sales, the CEOs and the sales teams, etc., to be engaged with customers, both fleet as well as with the dealers for their retail initiatives. So there's a huge communication training program at all levels of the organization that is going on, almost taking advantage of a virtual way of working. Gopal, if you want to add to that.
No, I think you have said it within. So I think there's a lot of initiatives that we're taking to reach the customer in different ways. And these are going to be important as we move, because this is not, the commercial vehicle industry of 5 years ago. So things have completely changed, and I think and the ownership patterns are changing, financing models are changing. So there's a lot of work that's going on at the back end. All we can share with you at this moment is there's a lot of work going on at the back end of transforming some of the ways we have performed. We're kind of reaching out to customers. And also the vehicles have also become more robust as we move forward. Significant drop in failure rates, and as we move forward, we are also seeing that the demand for fully built vehicles could go up. So we kind of readying ourselves for that. And for us again, Avatar, if you notice, is a complete new range of fully built trucks. And our strategy for buses is also the same. You will hear about it as we move forward in the next 2 quarters about what we're planning. But there's a much larger, I would say, cohesive plan that's coming in to ensure that we are better positioned to reach out to Indian customers as well as global customer needs. As Vipin had mentioned earlier, and we have shared with you, our ability to reach the global markets is also significantly better with a wide range of both LHD and RHD vehicles that we have today. So for us, I think we are ensuring that we are at a strategic advantage in comparison to the players that we have to face in the market, and hopefully this strategy is going to play out well.
Sure. Thanks, and all the best.
Thank you.
Thank you. A reminder to the participants, please limit your questions to per participant. Should you have any follow-up, request you to rejoin the queue, please. The next question is from the line of Pratik Poddar from Nippon India Mutual Fund. Please go ahead.
Yeah, hi. Sir, you indicated that, quarter 3, quarter 4, the growth could be fairly substantial. Is the supply chain ready for that ramp up? That was question number 1. Second is in terms of project reset. This is the first quarter that we would have seen some impact. Could you just highlight as to how should we see this in the next coming quarters flowing through? That is question number 2. And lastly, sir, if volume growth will be fairly substantial in the next 2 quarters, I'm assuming that a lot of working capital related debt which had held on in quarter 1 will now start getting released, and maybe by the year end debt will substantially reduce. These are the 3 questions.
Okay. Now, the only thing before I hand it over to Vipin is that we didn't use the word substantial. What we said is if the pundits forecast that the degrowth for the full year for the industry is going to be 25-30%, then logically Q3 and Q4 should be very good growth quarters. So we'll wait and watch, but simple math tells us that Q3 and Q4 should be growth quarters over last year. This is one. As far as the working capital and funding is concerned, we would want to ensure that we have we have an optimal working capital play here. The idea is going to be to ensure the following as far as the I would say the inventory and the finished goods part of it is concerned. We would want to ensure that we have sufficient inventory not to miss a sale. At the same time, we aren't going to pile up inventory when it is not required, because as we move forward, I'm not saying that this is going to happen in the immediate quarter, but as we move forward, modularity is also going to help us optimize our inventory. So as far as receivables is concerned, while we expect that with STU businesses coming in, there could be a little bit of addition to receivables, and that's not a pressure. Receivables, STU business or bus business has a certain amount of credit in it. But as far as a basic MHCV business is concerned, or international or LCV is concerned, or aftermarket or any of the other businesses are concerned, there is virtually negligible credit in the business. So that model is not going to change. we are well poised on the treasury fund to meet the working capital requirements, so we don't see working capital as a big challenge. And now over to you.
So on supply chain, your specific question was, is the supply chain ready for the ramp up? So the answer is broadly yes. Our communication with the supply chain is intense, so that we're giving them the projections as well as understanding what their challenges are, and if necessary, helping them as well to mitigate those challenges. So even within 10 days from now, we'll have our a strategic suppliers meet where all of us, both of us certainly, and the supply chain team will be present to individually and collectively speak with suppliers on the plans going forward. So the important thing is, are we communicating and are we ensuring that we are making payments on time so the supplier base is helped to ramp up. We don't see any significant issues as of this time unless there are some specific issues that come up.
And on the question of project reset, sir, and how should I think about costs in the coming quarters?
Uttal, you want to take that?
Yeah. See, I think project reset is, we on an overall year basis, we do believe that the cost will be lower than, at least on the administrative and selling overheads, they should be lower than last year. As far as that is our expectation at the moment, unless the ramp up is so high. I mean, we just have to play it out, right? The other thing is, we are trying to optimize our manufacturing overhead as well. But as, Vipin had mentioned, project reset is not about just taking cost out. Project reset is about, improving the bottom line through various means, which means we are also, we had an initial plan, like you said. What did we do in April was when the COVID came and hit us, all of us. What we did is we said the first focus is on safety, and we needed to ensure employee safety, and that was done very, very passionately at all levels, not only employees, but also stakeholders, drivers on the road, etc. And then the second one was liquidity, and we mopped up liquidity from the banks who supported us, unflinchingly, so that we had sufficient cash balance. And even as I'm talking to you now, we do have liquid funds available, in various liquid forms for nearly about 800 to 900 crores or even above. Now, the third thing was on cost and looking at, let's look at what do we expect COVID effect. If COVID were to be extended till June, July, where do we see revenues? What happens if the industry were to, take a slightly lower curve upwards? And we said we should ready our organization to have a bottom line which is most optimal. Now, I can't give a number for what it is, but we said we should strive to achieve the best bottom line given the circumstance. And that's exactly what you're seeing happening in Q2 as well. If that 2.8% EBITDA has come in, it's come in because you can see the effort that has gone into building that EBITDA. So we would want to pursue that, and that would come through not just cost efficiencies. It will be through value engineering. It will be through mix. It will be through special initiatives. It will be through revenue enhancement. So we are looking at a whole bunch of initiatives, and these initiatives are not short term. We are not taking out costs which are essential. Even as we talk today, while we do kind of share with you that we are going tight on Capex, we would want to ensure that we are also ready for the growth when it comes in. Otherwise, we would shortchange the future for the present, and that may not be good. So we want to see the overall structure of a balance sheet and a P&L. How are we positioned? As we see it, we are in a very comfortable position today, and I think the whole team has managed the overall challenges very efficiently from each of its functions. And so we would want to ensure that as we move into 2021-22, we truly get the benefit of operating leverage, which means we would actually see that when the revenue starts to go up, we are expecting that the initiatives that we have taken in the current year would start to pay off as we see, an operating leverage kicking in. This may happen even in Q3 and Q4, but we'll wait and watch.
Mm-hmm. So, sir, just finally connecting dots, you think, whatever the pundits are saying that, volume growth can be good in the coming quarters, plus the impact of project reset, plus balance sheet deleveraging, that is the way to think about it, right? As we go towards FY21 from here on.
As we look at 21-22, I would certainly say that as far as 2021 is concerned, I think I would again say that is a trajectory. That is what the team is aspiring for. Balance sheet deleveraging, I think, will be a factor of, how much of working capital is required. And I'm not too concerned, because if a business requires working capital and that working capital is for good purposes, if I'm building inventory which is required because my demand is going up, that's not a bad idea. If I'm having receivables because I'm getting into sectors where credit is offered but it saves credit, again, it's not a bad idea. But if I'm using up working capital which is actually going to fund my aging inventory or my aging receivables, that would be a cause of concern which we don't have at the moment. And we don't believe this will be a situation at all in Q3 or Q4 also.
Got it. The last question.
Mr. Poddar, sorry to interrupt, but for any follow-ups. Sure. Thank you. The next question is from the line of Raghunandan from Emkay Global. Please go ahead.
Thank you, sir. Congratulations on the recent product launches and improvement in balance sheet. Sir, my first question was on replacement demand. What is your current sense in terms of utilization of transporters, their profitability, and what would be the factors that would catalyze replacement demand ahead? Secondly, recently exports have turned positive, and considering your initiatives on the new LHD, RHD products, how do you see the outlook? Thank you.
Well, I'll answer this briefly, and but I would request Vipin to answer this. But first, the export front, like I mentioned, and like we shared with you in November last year, and even during some of the product launches that we've done, what we are doing is building capabilities as we move forward. So one of the most important things is product capability. So our current suite of products in terms of both LHD, RHD, in both in MHCV and in LCV is going to stand us in good stead because that's what the market requires. The second one is in terms of both projects and for retail. We are building capabilities in our current mainstays are in Middle East and in SAARC countries, especially Sri Lanka and Bangladesh. We believe that Bangladesh will also start reviving because Bangladesh had been slow in the first 6 months of the year, but we believe that the build-up will start happening. Sri Lanka will have to wait and watch because the demand will because they have also been impacted by COVID, but it looks like the market will improve there as well. But having said that, for us the next big market will be Africa as a continent, and we're not going to spray and pray there, but we're going to actually have select countries in which we would want to kind of deepen our presence. We are in talks with various business houses there as well as for potential distributorships, etc., which will help us to make a slightly deeper inroad into those markets. And then as we move forward, we would have Southeast Asia as well coming in. So we have our strategy overall carved out. We have made some changes in the organization as well, and we have also made some changes in the physical organization about where they should be located. And our focus is going to be much sharper on that. As far as your first question was concerned, which was, I'm sorry, I missed that one. Second one was export. The first one was on what?
The replacement demand.
Yeah.
I understand.
I would say that here I would request Vipin also to add, but I think the replacement demand would start kicking in as the sectors start to open up. So people have a reason to kind of replace these vehicles because as sectors open up, they would also want to have the latest vehicles coming in surely because of logistics uptime. So I believe that replacement demand would also start kicking in, and we haven't yet discussed about the scrappage policy, which I'm sure Vipin will share with you.
Yeah, okay. Now to start from exports, and Gopal, very eloquent. So product, LHD, RHD, and state-of-the-art products, BS6, and then of course we have the capability for non-emissionized markets to supply to non-emissionized markets as well as far as exports is concerned. It's a major thrust area for us. The second is, and Gopal alluded to it, distribution capability, especially in Africa and the Middle East. As we speak, and by end of March, this will be significantly enhanced with distributors who are capable of assembly, who already have a finance arm, who already have the capability to attract people for sales and service, and discussions are on with major people who are embedded in those respective countries in Africa, and then who can look after the neighboring countries and who are well acquainted with the way business is done in Africa and the Middle East as well. The structure, again, in terms of people, is being enhanced, and we will bringing in and utilizing our existing people to make sure that exports and international operations becomes a mainstay for future growth. So those building blocks are being put into position. I just wanted to say one thing as we are running out, is that whatever decisions we are taking in Project Reset or anywhere in the company, they are not for the short term. These decisions will stick and will be of great advantage to the organization in subsequent quarters as well. It's not that if we remove a cost, that cost will come back, and it's a short-term decision. They will stick and be there for the long term to give the company a major operating leverage as well as growth opportunities. On replacement demand, I don't think I have numbers, but we can see that utilization is going up for sure. Through the Uptime Center, we get utilization data. That's going up, and that's fed back to fleet operators and even to finance companies in some form, so that they know exactly where it is and how the asset is being utilized. Every quarter will be better than the previous quarter, I'm convinced of that. But we're going to open up international operations like never before, so that we then work with geographies which are wider and which will obviously go through their own business cycles.
Thank you, sir. Just a question to Balaji, sir. Yeah, I'll come back in the queue.
Thank you. The next question is from the line of Amin Pirani from CLSA. Please go ahead.
Yes, hi team. Thanks for the opportunity. Most of my questions have been answered, but just wanted to clarify, have you put out any guidance for Capex and investment for the year?
I would say that we at the moment are looking for a possible cash outflow for Capex for about 750 crores. I don't think we've changed that number, but as we had mentioned, we'll come back if we need to in the fourth quarter, but I think we should stay in that number. That's our current estimate. As Vipin had mentioned, as on September, our overall cash outflow on Capex was something like about 270 crores. So we still have about 500 crores of headroom available for us to do that. And believe me, these are all just expenditures which are for expanding our range or improving certain capabilities, and that's what we're looking at. And investments are concerned, like I mentioned, we would invest a bit into Optare. We would invest into HLFL if that's required. And very small investments happening in some of the other things like Alteams or anything like that, or some smaller investment that are happening. But we will again have a little more to share as we move forward, because whatever investment, rest assured on something, whether it is on companies which are not performing well also, or companies which are performing well, or companies which are performing neutral, like for some of our subsidiaries are, they're not really asking for big amounts of cash and able to manage. I think all of the existing, we have actually kind of restructured the whole thing over the last 5-6 years, if you notice. So we have Hinduja Tech, we have got Alteams, which is supplier of high pressure aluminum die casting. Then we have Albonair, which is again a very important subsidiary in terms of supplying BS6 emission nozzle systems. And then we have got Optare, which is another important subsidiary for us because it's in Europe and it makes state-of-the-art buses, and it has got its plant of its own, which we'll share in due course. And then we have Hinduja Leyland Finance, which is an immense strategic asset for us because it's a strategic asset for Ashok Leyland vehicles, and also for as an investment arm which has got its overall portfolios in other businesses also. So it's a good de-risking strategy as well. So when we are speaking, when we're putting in capital into most of these companies, it's being done in a very astute and measured manner. And I think that in the medium term, all of this will be accretive to the ROC on a consolidated basis of Ashok Leyland. That's the larger plan.
Answer. Just one thing.
What do you want to add in it? Sorry,
No,
I can put myself on mute. Yeah.
Good.
Just one follow-up on that, if you can share. Would it be fair to say that starting next year, at least the Capex number could start to taper down, or do you think that this would be the budgeted levels broadly for next year as well?
I know that you are looking at it, Amit, my dear friend, for modeling purposes. But we will take a call on Capex at the end of the current year, to be honest. We don't share next year Capex because the strategic planning process has just started. So we will look at what are our aspirations in terms of growth, and then we will decide on it. But you see, this won't be another huge Capex initiative. But we must also understand that just 2 years back, Ashok Leyland was a 30,000 crore company, right? So we have to look at it in perspective. And I'm sure that those revenues will come back. So we have to ensure that we are doing all the things that are necessary, but only absolutely necessary to put us back into that trajectory. So we will be conservative on Capex, rest assured.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question. I now hand the conference over to the management for closing comments.
I would request Vipin to do that. No, I would request Vipin to give the closing comments. Thank you.
Okay. First, ladies and gentlemen, thank you very much for your questions, for the time you've spent, obviously also to Motilal Oswal for setting this up. 3 comments really. One is quarter-on-quarter growth will return. The second is product-wise, we have launched virtually, and these products are getting a good response, and these products are for the future. And as is Ashok Leyland, always technologically ahead than most competition. And the third is that international operations building blocks being put into position. And finally, if I might add the fourth, which is whatever decisions we take on Project Reset will be for profitability, which is bottom line enhancement, and which will cover all aspects of the P&L, but will benefit the company for the long term. Immediate for sure, but for the long term as well.
So Dinesh, back to you. Thank you. Dinesh, back to you.
Thanks, Mr. Sondi, Gopal and Balaji. We'll close the call over here. Thank you.
Thank you all. Thank you.
Thank you. Bye-bye.
Ladies and gentlemen, on behalf of Motilal Oswal Financial Services, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.